Hey guys, Davis here. So in this video, I want to share with you how you can use LEAPS options to get your favorite stocks at half price or less. And this is very important, especially right now as the market is really tanking and you want to limit your risk to the downside by 50% or more. So I'm going to share with you exactly how you can do that in this video. But first off, we want to know exactly what are LEAPS options. So LEAPS is basically just an acronym and it stands for Long-Term Equity Anticipation Securities. And if you were to take a look at the option chain in your brokerage software, you will see that there's actually no label on the option chain whether it's LEAPS or not. So basically it's just characterized as having a DTE, which is days to expiration, of more than 1 year. Now, same thing, LEAPS, there are puts and calls. So call LEAPS are generally meant as stock replacement strategy, and it's better to use on non-dividend stocks because you do not get dividends with options. So if you were to just buy the stock, and if the stock was to pay you a dividend, then on the ex-dividend date, the stock will theoretically go down by the same amount that the dividends being paid out. So you actually do not lose anything when you are owning the stock. But if you own a call LEAPS, you actually do not get paid the dividends. So the value of your options is actually tied to the stock. So if the stock goes down, your option value will drop as well, but you are not being paid the dividend. So it's best for you, I would say that it's much better to use on a non-dividend stocks, or at least on a stock that pays very little dividends. There's also put LEAPS as well, and it's generally meant for long-term portfolio protection to the downside. So this is where many people would tend to use buy put LEAPS on index ETFs as a general protection in case the market goes down. So for the purpose of this video, I'll just only be talking about the call LEAPS options. So you must be wondering, why buy LEAPS versus stocks? So here are some of the advantages. So first of all, you get to control a stock at half price or less. Now, when I say control, it means you just get exposure to the underlying stock price movement. You actually do not own the stock. So I want you to take a look at this strike price at 60 right here. You can see that the bid is about 53, the offer is about 54, so you can roughly buy this option price at $54, and just by itself you can see it's already half the price of the current stock price. So the current stock price is about 108. If you were to buy 100 shares, that is about $10,800. So by paying only $5,400, you can get the same exposure of about 88 deltas with very limited risk compared to if you were to buy 100 shares of this stock. Now, of course, you can choose to pay even lesser if you will go to the 105 strike price. As you can see, with the 105 strike, you can buy this option at about $23, which is about $2,300. So you even further your limit to the downside. But I want to caution you here because if you were to buy this at the money option, you're actually paying more in extrinsic value. You see, if you were to compare this is the extrinsic value column. You can see that with the 105 strike price, you're paying roughly $19 in terms of extrinsic value, whereas the 60 strike, you're only paying roughly about $5. So there's a big difference, and you must keep in mind that when the option expires, all extrinsic value will go to zero. So what you're actually buying here is more extrinsic value. Although you are reducing your risk, most of this value is actually extrinsic value, and that means that the stock really has to go up a lot in order for you to break even and even profit, compared to if you were to buy much deeper in the money with a higher delta option. All right, but I'll get more into this in the later slides. So with LEAPS, you can actually reduce your risk by half just by simply deciding how much you want to pay for the option. So if you compare this to stock, with stock, let's say if you buy 100 shares of a stock that is worth $100 and it goes to zero, well, you lose the full $100 times 100 shares, that's $10,000. But if you bought the LEAPS options for $50, it goes to zero, then you only lose whatever you paid for, which is a total of $5,000. So just by that, you are really reducing your risk while still being able to get exposure to the upside. And the other good thing about LEAPS is that you actually make more as the stock goes up and you lose less as the stock goes down. And that's because the delta is dynamic. That means as the stock moves, the delta moves as well. So delta is just a measurement of how much the option price will go up or down per dollar move in the underlying stock. So let's say, for example, if you start off with a delta of 80, and if the stock price was to go up, the delta will go up as well. You go to 81, 82, 90, and eventually to 100 if the stock really goes up enough. So you're actually making more as the stock goes up. And contrastingly, if the stock was to go down, your delta will go down as well. That means you start to lose less as the market goes down compared to if you were holding stock. If the stock goes down $10, well, you will lose $10 on your stock as well. But in terms of LEAPS, it will lose lesser and lesser as it goes down. So if the stock goes down $10, chances are you'll probably lose maybe only 90, 80, or $70 out of $7 out of that $10 move down. So because of this, you have better risk to reward ratio. All right. So let's say if you have a stock, right? A stock at $100, the stock goes to $200. That means you make $100, and your risk is $100. Then your risk to reward is 1:1. But with LEAPS, your risk to reward is slightly better because your risk is $50, and if the stock goes up by $100, your profit is not $100, but your very close to it because your delta by then should be around 90. So you will make $90 out of that $100 move. So if your profit is $90 and your risk is only $50, which is what you paid for, then your risk to reward is around 1:1.8. So your risk reward is much better just simply because you have already limited the downside by a significant amount. So there are also disadvantages of LEAPS compared to stocks, and it's always a trade-off. So like I mentioned before, you do not get dividends. So when the stock actually pays dividends, your option price will go down and you do not get paid for it. LEAPS also have a fixed lifespan, and that's the expiration date. So this is where it can get confusing for a number of people because at expiration you're not sure what exactly happens. So if your option is in the money at expiration, it will be converted to shares at your strike price. So for example, if the stock price is at $100 at expiration and your strike price is at $70, then you will get 100 shares at $70 per contract. But what happens if your option is out of the money at expiration? Well, it simply basically just expires worthless. So if the stock price is at $100 at expiration, your strike price is at $120, then your option will be worthless. Now, of course, before the option expires, you can keep rolling your option. If you roll your option, you will increase the lifespan. But each time you have to take note that if you were to increase the lifespan, you just roll it to a further expiration date, you will have to pay more extrinsic value. So you're just paying for more time to keep like the lifeline of your options going. So this is where you really need to understand what you need to do if you are buying a LEAP. The other disadvantage, like I said, you have to pay extrinsic value, which will decay over the lifespan of the option. That is why, as much as possible, I want to pay as little extrinsic value per day when it comes to buying options. So here are 3 simple steps to buy LEAPS at 50% of the stock price, and this is my method. So the first step, what I'll do is I will look for the longest dated option, and the only reason is because option premiums per day are cheaper when the duration is longer. So it's the same analogy like if you were to just buy a bottle of mineral water. Let's say it could just cost $1, but if you were to buy 100 bottles of mineral water, you might get a discount on that. So per bottle, it might maybe cost you 80 cents or 70 cents if you buy more. So options work very similar to that, where if you were to go for the longer dated option, you're actually paying lesser in terms of premium per day. So if you will take a look at the strike price down here, which I've boxed off here, 110 strike price. You can see that this down here is the extrinsic value that you're paying for this option. So the extrinsic value for the 30 days to expiration strike at 110 is $6.08. So if you were to divide this by the number of days left, the options, it is roughly 20 cents. Now let's compare this to a longer dated option, which has a DTE of 583 at the same strike price. So you can see that the extrinsic value is $21.30. Now in terms of absolute value, it's of course much more expensive, but if you were to divide this by the number of days left, you will see that you're actually only paying roughly 3 to 4 cents per day compared to paying 20 cents per day on the DTE 30 options. And the reason is because the options tend to decay much faster when you reach the 30 to 45 days left in terms of the expiration. So as much as possible, I always look for the longest dated option because that's where I get the most bang for my buck, right? You're paying much lesser and the decay is much lesser. Right, step number 2, what I'll do is I will look for deep in the money calls, which is where the delta is more than 80. And the reason is that the higher the delta, the lesser we are paying in terms of extrinsic value. So you can see down here, this is the extrinsic value column, and this is the delta. The higher the delta, the lesser you are paying in terms of extrinsic value, and it increases in terms of extrinsic value as you get to at the money, and it starts tapering off as it goes out the money, because at this point all you're doing is you're just paying for hope. Basically, you're just hoping that the stock will go all the way up to your strike price, and if it goes to your strike price, you only break even. It has to go a significant amount. You have to go much higher in terms for you to profit. So that is why when buying LEAPS as a stock replacement strategy where you want to hold this for the long term, I would stay away from out the money options. So let's do a comparison here to see why I would prefer to buy the deep in the money and pay slightly more compared to pay less for the out of the money strikes. So if you take a look at the 55 strike, you can see that the cost is roughly $57.80. You can see this is the mid price, the bid is $57, the offer is $58.7, so the mid price roughly $57.80, and per option contract with 100 shares, that is $5,780. Now the break even, how you calculate the break even is basically you take the strike price and you add the amount that you paid for it, which is 57.8, and you can see that the break even is $112.80. Right now, as of this screenshot, you can see that the stock price is $108. So all it takes for it to break even is roughly $3. All you have to move is about $3 and change for you to break even, and any further than that, you will be a profit. So in terms of percentage, the stock only has to move from its current price roughly 3.79% for you to break even, and then after that it's all profit. Now let's compare this to an out of the money strike, which is 120. So this is not very far out of the money, but it's still a little bit out of the money, right? 120 strike. So in terms of the cost, you can see that you pay significantly lesser. You only pay $1,560 because for this option you can only all you have to do is just pay $15.60, right? So it's much lesser than if you buy the 55 strike price, but you must ask yourself the question, at what cost? So this is where you want to calculate the break even. So again, you take the strike price, you add the premium that you paid for it, and it's $135.60. That means in order for you to profit at expiration, the stock has to go above $135.60 compared to the 55 strike. All he has to do is just go above $112.80 for you to profit. So this is a huge movement. So in terms of percentage movement, you can see that the stock has to move from its current strike price 24.77% in order for you to profit, break even, and even profit, right? The stock has to move 24.77%, and your days to expiration is slightly more than a year, right? Maybe a year and a half. So if a stock, you have to make sure that your timing is really right, and it has to go up by this much in order for you to profit. So this is the reason why I do not want to go for a strike price that is at the money or out the money. I would want to pay much more for it and then pay very little extrinsic value, and all it takes is just a small movement for the stock to go up. So just imagine this. Imagine somebody was to say that, hey, I've got Nike stock right now at $108. All you have to do is just pay me $90 per share and you get to take my stock that's worth $108. Would you want to do that? You surely want to do that because your risk is only $90. Now, of course, we do not have that kind of deal, but the next best deal is what we have with LEAPS options, because all you're doing is you're paying $5,780, and most of this is actually in intrinsic value, which is the value of the stock that you're buying anyway, right? And all you're doing is only paying a minuscule amount of $4.17 just to be able to hold this position with half the risk gone. So I think this is a really good deal compared to if you were to buy at the money strikes or out of the money strikes, which I will definitely stay away from. So the final step is to simply just place the order at half price. For me, I like to pay 50% of it. So if, let's say, I want to buy the stock price at $110, basically I will go to the 55 strike and then place a limit order for $55 and wait for me to get filled. So this way, if the stock goes to zero, my max loss is only $5,500 compared to if I was to pay the full price of $108 per share, which is total of $10,800 plus. And if the stock goes to zero, I will lose everything. Alright guys, so that's it for this video. I hope it has been really helpful for you. And if you like this video, please give me a thumbs up and please subscribe as well if you like me to create more videos like this. Alright, I'll see you in the next video.